Exactly 1 year ago, Intel was trading below $20 per share. Today, it's above $130. That's a gain of over 466% in 12 months. And just in 2026 alone, the stock is up more than 200%. What happened to Intel? Is this the greatest corporate comeback in recent market history? Or is it a bubble about to burst? Today, I'm breaking it all down. To understand how extraordinary this is, you need to remember where Intel was coming from. For nearly a decade, Intel had become a symbol of corporate stagnation. It lost its technological edge to TSMC, AMD was eating its market share, and when the AI boom arrived, every investor looked at NVIDIA, not Intel. The stock eventually fell to near all-time lows, hovering around $20. The company was in survival mode. Then, in March 2025, Intel made its first decisive move. It hired Lip-Bu Tan as the new CEO. Tan wasn't just another tech executive. He came from the semiconductor venture capital world with decades of deep industry relationships. From day one, he started cleaning house, restructuring leadership, cutting costs, and focusing on two things that would prove critical: data center chips and the foundry business, meaning manufacturing chips for other companies. Back then, almost nobody was betting on Intel, and that's exactly the point. April 23, 2026 was the day everything changed. Intel released its first quarter 2026 earnings, and they left Wall Street completely stunned. Revenue of $13.58 billion, up 7% year over year, beating analyst estimates by nearly 10%. The street was expecting $13.07 billion. Intel delivered almost $500 million more. Adjusted earnings per share came in at 29 cents. Analysts had penciled in 1 cent or 2 cents. Let that sink in. Intel earned roughly 15 times more than the market expected. But the number that really got investors excited was the data center and AI segment, up 22% year over year, generating $5.1 billion in revenue, and sales of Intel's custom AI processors, known as ASICs, nearly doubled. CEO Lip-Bu Tan summed up the shift perfectly on the earnings call. A year ago, the conversation around Intel was about whether we could survive. Today, it's about how quickly we can add manufacturing capacity. The next day, the stock jumped nearly 24% in a single session. From the lows of late March to early May, Intel surged 214%, adding over $440 billion in market capitalization. The earnings were the spark, but there's a bigger story underneath. Let's look at the three pillars. First, the CPU's role in AI. For years, the market narrative was simple. In artificial intelligence, only NVIDIA's GPUs mattered. Intel, as a CPU maker, was left out of that conversation entirely. But the story is changing. AI is evolving. It's no longer just about training models, it's now about inference and agentic AI, meaning systems that operate autonomously to complete tasks. And for that, CPUs are critical. Lip-Bu Tan made a striking point on the earnings call. The ratio of CPUs to GPUs in data centers used to be 1:8. Now it's 1:4, and he believes it could move toward parity. For Intel, that's a fundamental shift in its addressable market. Second, the major partnerships. Intel has secured alliances that would have seemed impossible just 2 years ago. NVIDIA has committed $5 billion to Intel's foundry services. Google has a multi-year partnership for custom ASIC chips and selected Intel's Xeon 6 as the host CPU for its AI infrastructure. And Elon Musk plans to build his Terafab complex, a $119 billion facility in Austin, on Intel's next-generation 14A manufacturing node. On top of that, the U.S. government converted nearly $9 billion in federal grants into equity stakes in Intel, taking roughly a 10% ownership position. President Trump has publicly taken credit for Intel's revival, claiming the government has made over $30 billion on that bet. Third, Apple. On May 5th came the news that sent Intel to new all-time highs. Bloomberg reported that Apple is in preliminary talks with Intel to manufacture the chips that power its devices, as an alternative or complement to its reliance on TSMC. If that deal closes, it would be a massive validation of Intel's foundry ambitions. Apple would continue designing its chips in-house. Intel would simply manufacture them. Tim Cook himself has said chip availability is Apple's single greatest supply chain constraint. That day, Intel's stock jumped another 14%, pushing toward $130. Now, it would be irresponsible not to talk about the risks, because they're real and they're significant. First, valuation. Intel is now trading at a forward PE of around 119 times earnings. That is extremely expensive for a company like Intel. The average analyst price target sits at just $79, implying roughly 27% downside from current levels. Out of 44 analysts covering the stock, only 9 say strong buy and 31 say hold. Second, the foundry business is still losing money. In Q1 2026, Intel Foundry posted an operating loss of $2.4 billion. The business is growing, yes, but it is not yet profitable. Third, the Apple deal isn't done. It's preliminary talks. No contract has been signed. If those negotiations fall apart, the stock could correct sharply and fast. And fourth, short interest is near a 52-week high. Bearish traders are betting against Intel at levels rarely seen. They've already accumulated over $12 billion in paper losses, but they're not giving up. That tells you something. The skeptics still think this move is unsustainable. So the question everyone is asking, do you buy, sell, or hold? The honest answer is, it depends on your time horizon and your risk tolerance. If you're a long-term investor who believes in the thesis that Intel is building the Western alternative to TSMC, backed by the U.S. government and with major customers like NVIDIA, Apple, and Tesla, then the story makes sense. But entering after a 200% run means accepting serious short-term risk. The prudent approach: if you want exposure, build your position gradually, dollar cost average in, and be prepared for significant pullbacks along the way. If you're a short-term trader, the reality is that the RSI is at extreme levels, and the next known catalyst isn't until the Q2 earnings report estimated for July 23rd. Any disappointment or a breakdown in the Apple talks could trigger a sharp and fast sell-off. The single most important thing to watch right now, an official confirmation or denial of the Apple deal. That news alone will move this stock dramatically in either direction. Intel went from the edge of irrelevance to one of the most talked about and most divisive stocks on the market in 2026. The comeback story is real. The earnings prove it. The partnerships back it up. But the speed of the rally has created a valuation that demands near-perfect execution going forward. Is Intel the next NVIDIA? Or is it the new Cisco of the year 2000? The market is betting on the first. Time will tell who's right. If you found this valuable, hit like and subscribe, because with Intel, the next few months are going to be anything but boring.